Good afternoon. It's 1:30 and you're joining us for a special question and answer programme with our panel of Sky News expert editors to talk about the financial crisis affecting the pound. Joining me to answer your questions are City editor Mark Kleinman, our business presenter Ian King and our economics and data editor Ed Conway. We've got loads of questions, actually. Lots of people are watching and have got lots of questions. Let's whiz through them. Let's try and keep our answers short. I'll start with you, Ed. Jonathan has got in touch. He says, is it possible the mini-budget could work if given time? Is it a case of holding on nerve?
There's lots of really interesting kind of good supply-side reforms in the budget. And if there weren't this terrible market chaos...
What are supply-side reforms?
Supply-side reform. It's basically kind of taking different bits of the economy that could work a bit better and making them work better, whether that's like planning. So essentially kind of you've got planning, make it easier to build homes, you've got kind of, infrastructure. All of that stuff, if it was actually implemented, that could really help growth. There's interesting, and also changing kind of the capital allowances scheme, so businesses can basically invest more and not have to pay as much tax on that. But the issue is we're in this storm at the moment, and so right now the storm is the story. If we spend all our time talking about supply-side reforms, which is what the government wants to do, we're not addressing this massive fire that's happening right now. So.
That's a no, then.
For the time being.
Ian, to you, Les has got in touch. Where does the Bank of England get £68 billion to buy debt? Are we effectively just printing money? And if so, will that further weaken the currency?
Well, it's electronic money essentially, the Bank of England creates money electronically and then will buy these gilts in the market, and people are paid accordingly. It's exactly the same as the way that quantitative easing works. It's a big expansion of the money supply. It's a big expansion of the Bank of England's balance sheet. Does it... what was the second part of the question? Does it...
will it not weaken the currency?
Not necessarily.
In a way, it's strengthened it, actually, because people are like, oh, actually... we don't need to panic as much. The bank, though, is desperate that no one compares it too much to QE, quantitative easing. Yeah. Do I need to define quantitative easing?
Go on, then.
It's when you pump money into you kind of electronically print money and then put it in and get it in there. And they're like, well, it's not quite the same because we're not putting it in there to get more money flowing around. It's specifically focusing on these markets. But that just shows you how... The
more sinister question, and the reason that the bank, by the way, doesn't want people to say it's like QE is because, effectively, the government's just announced a big expansion in borrowing. And effectively, you could say the bank will mop up some of the extra gilts that are being issued to pay for that via QE. That's why debt monetisation, as it's known in the jargon. And the Bank of England does not want anyone talking or even hinting at that because it chips away at the bank's independence.
Okay. That's Zimbabwe.
Yeah. Which slightly links in with the question that Matthew has. What will be the lasting impact of the Bank of England buying bonds? And how will this affect this generation and generations to come, Ian? Well,
ultimately, the bank... this is the great irony. A week ago today, the Monetary Policy Committee had raised rates, but the other big significant thing, which I remember talking to you about at the time, is that they're also going to start unwinding their asset purchases. QE, as Ed just described it, which began during the financial crisis, went on pause, was revived during the pandemic. And the bank has accumulated something like £868 billion worth of assets on its balance sheet. It was going to start selling those off and selling that down. Ultimately, it will have to unwind those positions and start reducing the size of its balance sheet in exactly the same way, by the way, that the US Federal Reserve is doing as well, and the European Central Bank is committed to doing. All of these banks have expanded their balance sheets.
But could then we be paying for that for generations to come?
Potentially, but it's because this is a monetary... So because they are kind of creating money to put it into the system, it's not quite the same as, like, taking out new debt. It's, potentially means you have a kind of... no. The answer... I think the answer basically...
Is the answer you don't know, Ed?
The answer is...
I'd be very excited
I have no clue.
It
it's a bit of a wormhole, QE. The answer is no. OK, it's not the kind of debt that the government takes on and kind of tries to lend to people. It's supposed to just kind of, once it gets withdrawn, to be withdrawn from the system through a kind of form of tightening. It's bank reserves, which is a very short-term form of money. But it gives me a headache thinking about this stuff.
And don't forget, we've seen ministers like Andrew Griffith yesterday, Chris Philp this morning on Sky News, all talking about the fact that the UK's debt to GDP ratio is actually lower than most other G7 economies. That's the government's position. That's why they say, look, this extra borrowing, we can live with it.
But the other point is that, some of the other Western economies that you were talking about earlier, Jane, that have had to step in recent weeks to support their currencies, all of this adds up to the fact that the era of cheap debt that we saw after the 2008 banking crisis is now finally looking like it's coming to an end. And the consequences of that, maybe Ed's right, and our children and grandchildren won't be dealing with the consequences of what the Bank of England and the government have done over the last week. But nevertheless, there are consequences from the unwinding of those banking crisis era policies. There's no doubt about that.
OK. I wondered when Brexit would come into this discussion, and Fergal Liston has brought it in. Give this one to you, Mark. Would the government have had the flexibility to impose such a mini-budget if the UK was still in the European Union?
To a large degree, yeah, because the government is still responsible for domestic tax policy. One exception to that would be the announcement last Friday about the decision to remove the cap on bank bonuses, which was a piece of EU legislation introduced after the financial crisis. The government couldn't have done that they couldn't have done that inside if the UK had remained inside the EU. I mean, the other point is that was part of this broader push for deregulation in the city and the financial services sector that the government is obviously very, very keen on. But whether it can go ahead with that now, given the current crisis that we've been talking about for the last couple of hours, that's open to debate.
So I guess what the person is trying to push at is if Brexit hadn't happened, would this mini-budget have not been able to happen?
Well, the mini-budget in itself would have been able to happen, and many of the measures in it to do with income tax and some of the supply-side reforms that Ed was talking about, yes, for sure.
It certainly wouldn't have been able to have happened had the UK been in the Eurozone, but the EU membership isn't an issue.
OK. Terry got in touch. His question is, how did these changes go ahead without scrutiny from the Office of Budget Responsibility?
Well, the government said it didn't want an OBR forecast. And, it kind of is simple. The OBR has to produce 2 forecasts every year. It usually does them alongside budgets and spending reviews and stuff like that. This time it offered to do some. It said we're not going to be able to do quite as extensive forecasts as we normally do because it's quite a short time horizon, but we can do it if you want to. And the Chancellor said no, and that's it. It was his decision. And
so it's not the case that they have to do one.
Well, they have to do 2 a year, OK. And so they've done one for the budget earlier on this year, the real budget, not that it was quite as big as this one, and they are going to do another one on the 23rd of November. We now know, and we knew that they were going to do another one within this fiscal year. But the key thing here is they didn't do it this time around, and that was, as far as I know, that was basically up to the Chancellor. He said no thanks.
But isn't that a bit of a, my question? If you know that the OBR has to do another report by the end of the year and you're putting together a mini statement, wouldn't it make sense to ask them to do it into your budget?
Yeah. Sorry, you want short answers? Yes.
OK, fair enough.
And we know they were primed for it as well. That was a bit of information that the Treasury Select Committee wheedled out of them.
And one of the points is that the Treasury and the government would not like us to have concluded this, but one of the reasons for the extreme reaction that we've seen over the last 5 or 6 days is because there was no OBR forecast built in.
Indeed. David Roy's question next. Does this make an imminent UK market crash inevitable? And what ripple effects would that have on global markets? Mark, do you want to have a punt at that one?
No, it doesn't make it inevitable. I mean, assuming that the question is based on the UK stock markets, no, it's not inevitable. There's pressure clearly on equities at the moment, partly because of the pressures that we've seen this week emerging in pension funds, which are having to sell shares in order to raise cash to meet the collateral calls. That's one dynamic that's taking place. But no, a market crash is not inevitable. We haven't talked about the idea of the echoes of 2008, which have really been, for those of us who were covering that banking crisis nearly 15 years ago, there have definitely been some distinct echoes in what we've seen in terms of market behaviour this week. But the key thing to say is that we are not, so far as I know, on the brink of a major banking crisis. This is a liquidity crisis that we've seen in pension funds, for example, this week, and there is obviously a crisis of market confidence in what the UK government has announced. But it's really difficult to talk about any market crash being inevitable.
It's actually worth pointing out that the FTSE 100, which has been a dog for the last 20 years, has actually been the best performing Western stock market this year. It's only down by about 4% since the beginning of the year. The S&P and the Dow in the US are off by 22%. All of the big continental European stock markets are down by much more than the FTSE. And the FTSE actually benefits from the falling pound, because something like 60% of all company earnings from FTSE companies is derived in US dollars. So you get a stronger dollar. That translates into higher sterling earnings when you do the translation effect, which is why all of these big dollar earners have kind of kept the FTSE afloat.
OK. Next question is from John. This is also about the link between the pound and the dollar. What's the forecast for the pound against the dollar, the exchange rate? Can we expect to see it improve, or do you think it'll drop further in coming months, possibly reaching parity at some point?
I'm always too loath to make a prediction on currency. There was a former US Treasury Secretary, Paul O'Neill, who was asked by a journalist why the dollar was so strong, and he said, what makes you think you know more about the dollar than the hundreds of people who trade it around the world every day? I mean, the market consensus is that, well, it was certainly that we would test the all-time low, which was $1.05, which was on 25th of Feb 1985, and we did that overnight on Sunday. So the next stop lower below that is parity. And there is a school of thought in the market that you could see that. But, I mean, Ed did some great charts on this earlier in the week where he pointed to the sort of long-term decline of sterling going... I mean, it used to be more than $4 back a century ago, and it's been one-way traffic ever since. It's perfectly feasible that you could see dollar parity to sterling, yeah.
Do you want to add to that? I mean, do you think that is going to potentially happen?
Well, no one knows. No one knows. Sorry to be annoying, but no one knows. And like Ian was saying, you know, the former chairman of the Fed, the US central bank, like the place of all places which you would have thought would have all of the kind of details and the abilities to model what's happening in currencies. I spoke to Alan Greenspan about this, and he said we put so much effort into trying to predict currencies. You know, had the best possible data, the best possible models. It was rubbish. It was rubbish. So no one knows, because these things, what are they? They're massive manifestations of decisions that people are taking across the world, some of which are kind of rational, some might sometimes be irrational. We just don't know. Like Ian says, it's entirely plausible that it goes down to parity or maybe even a little bit below. But it's pretty stable today, and, you know, just take one day at a time. I know that's not very helpful, but it is the truest we can be about this.
Yeah,
I think.
Nobody knows. I think that's the key thing. It's not the case that there's some sort of Machiavellian creature who knows all of this.
No, but we're kind of in a period of lack of confidence at the moment, and that's kind of what's determining things, which again makes it kind of quite unpredictable, but means that you could, you know, what's the reasonable value of sterling? Maybe it's probably weaker than it could be, but again, you know, determining that's difficult.
And don't forget, I mean, the reason the dollar has been turbocharged this year. Even before events last week, it was up 16% against sterling on the year. The Fed is tightening monetary policy more aggressively than anyone else. They've gone far faster and far more aggressive. And if they carry on doing that, and we know that from Jay Powell, the Fed chairman, he said he's prepared to risk a US recession to get inflation under control. Well, if you do that, then theoretically, that means more aggressive tightening, more dollar strength.
It's been interesting, actually, Jane, because this week we haven't had many chief executives of big companies coming out and criticising overtly the UK government for what's been announced in the last few days. One of the exceptions to that has been the chief executive of Virgin Atlantic, which of course relies on strong demand for transatlantic air travel. And the chief executive of Virgin Atlantic was very clear that he wanted the government to reverse some of the tax cuts announced in the mini-budget last week in order to improve the prospects for sterling. Now, clearly, one chief executive is not going to influence government policy, and it's interesting that we haven't seen more explicit criticism from the business community, but nevertheless, it was interesting. You can see the real-world effects in the economy.
Well, the real-world effect, if you go, you know, anybody who went on holiday to America recently knows the real-world effects, and Virgin Atlantic will know that.
Absolutely.
And all its costs are in dollars as well, a lot of them are.
Yeah, the travellers are not getting what they used to. We had a question from Rebecca. She says, I have a pension scheme with my employer. Is it at risk? And Ian, we talked about pensions and the concerns that there were about these pension gilts, and people will look at this and go, well, hang on, are pensions all of a sudden at risk?
So what we don't know from that question is whether she's on a defined benefit or a defined contribution pension, the final salary in the jargon, where your employer guarantees you an income in retirement that's based on what you were earning at the time of your retirement, or defined contribution or money purchase, as it's known sometimes, which is where the risk lies with you, the retiree. You put aside money in your pension, your employer will put some money in your pension, but how it performs influences what you get out of it at the other end. So without knowing what Rebecca's situation is...
I guess it's the one that performs, isn't it? That would be the concern, because if you know your pension's safe.
Yeah, I mean, again, it depends on how old she is. I mean, she might be in her 20s. She's got another 40 years of her working life. But if she's... I mean, the issue over the last 48 hours has been over defined benefit pensions. In other words, the ones where your employer guarantees you a pension in retirement. A lot of that actually depends on the strength of the employer themselves, because obviously if the employer goes into administration, then potentially the pension fund is an unsecured creditor, and that's pretty scary.
Yeah,
but
we've seen that happening over the last few years.
Yeah, but I mean, if she works for a solid blue chip company and they've made these sort of pension guarantees, then she ought to have nothing to worry about. But without knowing her specific circumstances, it's hard to say.
And certainly, we don't want to be alarmist, but I've heard anecdotal evidence in the last few hours of pension schemes being so worried about their funding position, corporate pension schemes, large employers, where the pension trustees have gone to the company that stands behind the scheme and asked for the company to lend money to the pension scheme so that they can meet their financial obligations. Now, at this stage, no names of those companies have been disclosed, but the reality is if that sort of request is being made by pension trustees, you can be sure that there is some real anxiety among pension trustees and the sponsors, the companies that stand behind those schemes.
By the way, it's worth sorry, I know this is a technical point, and I don't want to labour it, but it's worth actually pointing out that higher gilt yields and higher bond yields are actually, in effect, quite good for occupational pension schemes, because pension deficits, scheme deficits and liabilities are calculated on bond yields. And one of the reasons over the last decade we've had all these issues with companies having to put more money into their pension funds is because we've been in a period of ultra-low interest rates, ultra-low bond yields. So higher yields, in theory, are quite good for pensions, and certainly good for narrowing scheme deficits.
Well, staying with pensions, Kane has asked what exactly would it have meant if pension funds collapsed yesterday? Ed?
Well, I mean, the concern that the bank had, and I think it's a very reasonable concern, you know, pensions are an enormous part of the investment landscape of this country and other countries as well. And if you have a problem happening there, then it can cause a kind of ripple effect that affects banks, that affects obviously companies that are kind of sponsoring those pensions. And then you see it going throughout the system of government bonds. And when that happens, all bets are off. And that's why the bank stepped in to try and kind of nip it in the bud. So that was the concern. Not just about pension funds. As Ian said, you know, there are various protections that ensure, even though that many of those funds are kind of struggling with these investments at the moment, that there are lots of things between, you know, you as a potential beneficiary and things going wrong over there that would potentially click in. But it's not just those pension funds, it's the fact that it's a wider threat of there being a crisis throughout these markets that the bank was concerned about. The difference, and it's worth just kind of going back to that question, you know, that comparison with the financial crisis. Back in 2008, the world's financial system was effectively insolvent. You know, that was the scale of what we were facing at. You know, banks across the world were essentially unable to fund themselves. This is a very different world, and this is a very discrete, different crisis, and it has a very different likely cause, which is what happened last Friday. It's worth just remembering that. It's not like the entire edifice is falling down. It's like there's been some problems there. Some big questions about what happens when we kind of get interest rates back to a kind of normal level. We're all still wrestling with that at the moment. It's a really big deal. But it's a different world to the 2008 world, thankfully. And
I think in terms of pensions, that is by and large, for most people, the main place that money is saved over the long term. But Henry's question is, what is the effect on the current financial turmoil on savings accounts? are we going to lose our savings? I mean, Ian, that strikes me as being unlikely.
There's a deposit guarantee scheme backstopped by the government, whereby the first £85,000 of your savings is guaranteed by the government. So even
for each institution.
For each, absolutely right. Yeah. Make a personal finance reporter of you yet, Jane?
I've been listening to some of the people I've interviewed.
Yeah, so your first 85 grand is effectively safe, but as you said, after that you've got to switch it around from institution to institution.
Right. So that's the best way to. But you know, in theory, if you've done that, your savings should be safe.
Yeah.
Great. Mike, his question is it possible that the whole effort from the Bank of England to stabilise the market could be tipped off, he says, in November when the government puts forward their plan in full?
Well, OK, there's two things, really. There's the Bank of England's intervention, OK? That's actually just a 2-week thing. So even before we get the government's giving their plan at the end of November, there is the question of whether they're going to renew that, whether they're going to roll it over, and what that actually means for these bits of the market. As Mark was saying, the pressures have not gone away on many of these funds and the way that they've structured their investments. So that's one thing, the Bank of England and its intervention here. Does it need to extend it? And then there's a second thing, which is whatever let's say the government survives, let's say they make it through, let's say that markets don't have another tumble in between now and the end of November. If they provide something that doesn't satisfy markets and spooks them out, then we'll have to see. I mean, we could have more instability at that point because people are watching and waiting and looking for a credible response. So, again, we just have to kind of take it one day at a time and see. But, yeah, all eyes on them.
The next question, this is an evil one to throw your way, Mark. I know you're going to wince there. Has anyone asked the former Chancellor Rishi Sunak what he thinks? What would he have done differently? They've not given their name.
Is that from you, Jane?
No, it's not from me.
Is it from Rishi?
Yeah, is it from an R. Sunak in Yorkshire?
Exactly. Well, look, I mean, the Conservative leadership campaign was, when it came down to those two final contenders of Rishi Sunak and Liz Truss, one of the fundamental differences in their campaigns was their policy on the economy. It was their policy on tax cuts. Liz Truss was adamant that she was going to announce very significant tax cuts, and Rishi Sunak was not minded to do that. So, I mean, I have no idea what Mr. Sunak thinks this week. I suspect as somebody who's a patriotic Brit, he won't be pleased, and somebody who was the Chancellor until very recently, he will not be at all pleased by what he's seen. But clearly, all of the factors we've been talking about for the last couple of hours, the lack of an OBR forecast, the criticism from the IMF, the fact that the tax cuts that were announced last week were not anticipated by markets and investors, all of those things added up to the kind of real crisis that we've seen unfolding this week. Mr. Sunak probably would not, had he won the leadership election and become our Prime Minister, he would not have announced a similar set of measures last week.
In answer to the question, there's a queue almost as long as the queue we just had outside here in Westminster to see the Queen lying in state, to try and get any kind of response from Rishi Sunak. Among journalists, everyone wants to know, but he's keeping very quiet.
He is, and we know he's not going to be at the Conservative Party conference this weekend as well. Only a few questions left. Sean, I'll put this one to you, Ian. Will the UK property market crash, given that over 40% of mortgage products have now been removed from the market?
Very good question. Depends on his definition of a crash, but I find it inconceivable that there isn't going to be some sort of reaction in the property market. And here's why. So we've had the Bank of England raising interest rates over the last 10 months from 0.1% to 2.25%, and probably they'll go again by at least half a point next time around. It hasn't affected mortgage borrowers that much because something like 94% of mortgages taken out in the last 3 years have been on a fixed rate. So, and I think 74% of the overall mortgage market, their loans are fixed. So they're not affected by higher interest rates. The problem emerges when they start to roll off those fixed rate deals. Now, something like 650,000 homeowners will do so in the second half of this year. Something like 1.2 million, I think it is, 1.2 million. Next year, their mortgage deal is going to expire. They're going to find themselves paying a hell of a lot more for their mortgages. Even someone on a very, very average, typical family mortgage will probably be looking at upwards of £200 a month or more. That's if, say, mortgage rates get to about 6%, which I think is pretty lightly the way we're going. So you're looking at hundreds of pounds of extra mortgage payments in parts of the country where houses are expensive, like London and the home counties. potentially you're looking at thousands of pounds extra every month. I find it inconceivable that house prices are not going to crack under those circumstances. Now, I don't want to get over, terrify people because, there are still supply and demand mismatches in the market. That's what's kept the market afloat, that and ultra-low interest rates. But I find it inconceivable that the fact that all of these people's mortgage payments are going to go up is not going to have an impact on the housing market.
Yeah, and Ed, we heard from John Bulger from Charcoal, who's a real keen watcher of the housing market, saying he thought 10 to 15% drop would possibly happen in the market.
Yeah, but bear in mind they've gone up by about 15% in the last year. House prices up until recently were going up faster than the average house price gained more than the average person got in their annual salary over the last year. So it was going gangbusters, but as Ian says, that's a massive shift. And people coming off their current fixes, that peaks next year just at the moment that interest rates are going to potentially hit 6%, hopefully not, but we'll see.
Last question, and it's a good one from Keith. If the Bank of England has to step in to prop up the financial markets, then is this not proof of the government's failure? Ed?
Well, Keith might very well say that. I couldn't possibly comment. I mean, it's very... Oh, gosh, how to put this? Something happened last Friday that spooked markets and has led to an incredible disturbance that has caused the Bank of England to have to intervene. Something happened. The government would like us to believe it was not something they did, but nowhere else around the world is facing anything quite like this. So either we believe that this was an enormous coincidence and we were just terribly unlucky and just out of nowhere this act of God or bad luck happened, or it was down to something that happened at 9:30 on Friday when Kwasi Kwarteng stood up in the House of Commons.
And governments always pay the price for sterling devaluations. Harold Wilson did, John Major did.
That seems a good point to leave it. Ed Conway, Mark Kleinman and Ian, thank you both. Thank you all so very much. Great to have you, and thanks so much for answering all of our viewers' questions.